in partnership with FIT in organizing this conference. Our partnership is a natural one, as both organizations share a joint mission. This is the mission to spread knowledge of international tax to all who seek it. We are happy to partner together to deliver this event. Over the next 2 days, we have a rich program covering issues of policy, practice, and administration. Over the next 2 days, we have a rich program covering issues of policy, practice, and administration. We begin today with an overview of international tax developments, always with an eye on the relevance for India.
Pleased to welcome you all. When India handed over the G20 baton to Brazil just last week, it marked a historic first on the G20 completed mandate for 3 developing countries altogether, Indonesia, India, and Brazil, consecutively holding the G20 presidency. India's G20 presidency was a success on multiple fronts, apart from the invitation to the African nation to become a part of the G20. As an international lawyer and as someone who's closely witnessed the evolution of international tax policy, both at the domestic and at the international level, we also saw in the last fortnight a historic UN vote.
I set up the foundation. We had applied for the name International Tax Foundation. The Charity Commissioner rejected that because he said we can't have prefix as international. I then gave the presentation of Roy's book, International Taxation, to him. He said, oh, this is the subject, but I know, but our guidelines doesn't permit. So, why don't you interpolate your name and put the international somewhere else? I said, okay, sir, Foundation for International Taxation. So that is how we became fit. And when I conveyed it to Roy, he said, it's fantastic. We are now fit. And he has been fit for since then.
We all owe Roy a tremendous debt of gratitude for establishing the FIT IBFT conference as a recognized signature global event in the international tax calendar. I can surely say that without Roy, we would not be here today. I also congratulate Belema and Mukesh for putting together another exceptional conference program. In this conference, as in the past, you will continue to hear from global international tax leaders, policymakers, academics, government representatives from India, members of the UN Tax Committee, and leading professionals from across the globe, and also from Mumbai and the rest of India.
In contemporary societies, May's observation finds a striking resonance, particularly when it comes to commercial relationships. Contracts, as legally binding agreements, have become an integral part of the lives of individuals and corporations. They indicate the terms of various transactions, which include selling, leasing, servicing, incorporating, merging, acquiring, and creating assets or business commercial. These contracts operate within the framework of an integrated legal system and profoundly influences the tax consequences associated with these commercial activities. Contracts in their manual forms allow parties to structure their commercial relationships and thereby shape the tax implication of their business endeavors. Importantly, these agreements can even determine the very tax unit under which the parties operate.
Thank you, and good morning to everyone. And in order to ensure we proceed quickly, I would like to invite all members of the panel and the speaker, Mr. Dinesh Kanaba, Ms. Yvette, Mr. Rasmi Ranjan, and Professor Annette Ogotu to please come up and take your seats. So first of all, my welcome to all of you to this FIT IBFT International Taxation Conference. I have been involved in this many years ago, and then I'm back now in Mumbai. And previously when Professor Roy Rohatgi was very involved in the program as well. Now, as you know, the theme of this particular conference is Reshaping the International Tax Architecture in an Era of Multilateralism. So the topic for this particular session is on evolving trends in global taxation.
Fellow panelists and our dear guests, you're welcome, and I am very happy to be with you today. In the last 100 years, the international tax regime has been characterized by mainly 4 elements. That is the sharing of taxing rights between source and residence countries on active and passive income through treaty negotiations. Double taxation elimination, which is done unilaterally by jurisdictions or through tax treaties. Profit allocation to entities in a global value chain based on the arm's length principle. And finally, and most recently, tax transparency through exchange of information.
Very wide spectrum of presentation which Yvette presented, and which was, thank you so much, I think it came across very well, and we're looking at a breadth of subjects, whether it is, we are talking about the global nomad or UN versus OECD, which are the 2 things, how do we move forward? There was this discussion in the morning, and I agree that there is a lot of agreement and a lot of room to converge on both the sides. But before we begin the panel discussion, let me first do a brief introduction of the 2 panel members who have not yet been introduced. Let me begin with Mr. Rashmi Ranjan Das. I think there's scarcely anybody in this audience who would not know him, because he has been with the Revenue Service for more than 30 years, huge amount of experience on international tax, policy making, implementation of policy.
I think most of us will agree that there is almost an agreement, or rather recognition among countries, that we need multilateralism. We need a multilateral solution, because in the globalized, digitalized economy, you cannot have bilateral solutions, or you cannot have unilateral solutions. That we have seen in the BEPS 1, which evolved further to inclusive framework. Now hopefully it now is evolving into the United Nations. And along with that, as Professor just remarked, there will be regional organizations like ETAF, and we have a Latin American platform coming up. So that is the trend you will see, multilateralism, trying to find out multilateral solutions. The second, along with that, the multilateralism doesn't mean only signing treaties. It can also have a system of a soft law, international tax, like say Pillar 2, a best approach type, which of course subsequently we can have discussion about, subsequent discussions can go about what Yvette was referring to, how to tax metaverse or the crypto, because here this is not about taxation of countries or allocation of rights. It's finding out what is the best way to approach taxation.
Just tracking the international developments over 100 years, as Yvette has just said. Developing countries, by the time these rules were developed, developing countries at large were besieged during that time, and now we're talking about the times of World War I, World War II. They were being besieged by the ills of colonization, and there wasn't much input from developing countries. Apart from your Mexico draft towards the development of border tax treaties, where they were pushing for source taxation, but that was obviously watered down by the London draft, and then developing countries pushed for the UN to come up with a UN model, and over time we see that the work of the UN model in championing the cause of developing countries was pushed on, but with not too much oomph, as we see has been done with the UN.
Good afternoon. Post-lunch is a difficult time for the presenters as well as the hearers. And I'm Raman Chopra, Joint Secretary Tax Policy. And in the first session, it came up a couple of times that I'm speaking here. Any government official who appears in any conference speaks on his own behalf. It is not speaking for the government. But there is an important other side to this statement. When he's hearing on behalf of the government. And that is most critical. That is why I am here, in fact. I am here more to hear everybody, all sessions, not this session, my panelists, the earlier panelists, the panelists coming after us. Government wants to know the perspective of the stakeholders. That has been the focus of this government throughout the last 10 years.
And good afternoon, friends. Thank you for coming in for the session. I know it is difficult, and but this is an intimate audience, and we as a panel are looking forward to discussing some of the latest developments in Indian tax. Again, it's an honor and a privilege to be back at the FIT, and in such a momentous occasion where we were also commemorating the founder, Dr. Professor Roy Rohatgi, as well as the 25th anniversary occasion for FIT. Many of us as international tax professionals have learned a lot at this foundation, and we will continue to give back to the society through this medium.
Thanks to Shefali for wonderfully laying the outline or the background within which we are required to discuss certain developments that have happened today. From 2016 to 2023, 7 years have happened when MLI came into effect. Therefore, before we get into the technical nuances, it becomes also important for us to understand the impact that MLI has had today. Therefore, we need to pause and find out as to what the future holds for this MLI. And we can study that best by looking at certain statistics, both from an India level as well as from a global level.
Thanks, Shefali. So, Mr. Kincha just alluded to the intense complexity of having two separate documents side by side and having to read them together. Since this example is a little involved, before I begin, I would like to offer a couple of propositions which I think are useful when we're reading treaties. The first is that there is a fundamental difference between domestic interpretive techniques and treaty interpretation. The reason for this is that a treaty is an agreement between two contracting partners. And so what is in the crux of that agreement is very important to understand. And if I could borrow or slightly morph something that Tolstoy said, all happy treaty partners are alike, but all unhappy treaty partners are unhappy in their own way.
Mr. Kincha gave a nice perspective around how many treaties are impacted, and he also mentioned that in the context of India, a few major trading partners, the treaties are really not modified. UK is one example where treaty is modified, and another example is Singapore, where we do receive a significant foreign direct investment. I just want to lay down the context to the India-Singapore treaty just for reference, and then bring the MLI consideration as well. Before 2017, the treaty between India and Singapore provided for a exemption from taxation of the capital gains in the source state. So if a Singapore resident were to sell the shares of the Indian company, the capital gains were allocated to the Singapore and India did not have a right to tax.
Distinguished FIT IBFG hosts, colleagues, guests, and delegates, I am very honored and very pleased to chair this next session on preparing for the global minimum tax. We know from the conference materials how this has been progressing in the last year, and our session is about how should we understand Pillar 2? What are its fundamentals? How does it interact with traditional tax infrastructure, tax treaties, incentives, anti-avoidance, and more? And what challenges and opportunities does it bring for capability building, for training up businesses? What are the implementation next steps? What comes next?
Thank you, Rebecca, and my thanks to the organizers for having me here in person to share with you an overview of the critical developments in terms of the GLOBE proposal, more commonly known as Pillar 2 or the Global Minimum Tax. So what is Pillar 2? Pillar 2 introduces a new taxing mechanism whereby MNEs with a global turnover of more than 750 million euros must pay a minimum effective tax rate of at least 15% in every jurisdiction in which they operate. The ETR is simply a ratio of the MNE's taxes due in that jurisdiction divided by the MNE's global income from that country.
So we are going to get into a panel discussion right now, and the topics that we are going to address are basically in relation to the compatibility of this Pillar 2 framework with tax treaties. We spoke about tax treaties in the first and second session. We will touch upon this topic once again. After that, we'll also discuss a lot about tax incentives, the last slide which Rachel had on her presentation. We are also going to touch upon the question of whether or not still need anti-avoidance rules in the existing system, given the fact that Pillar 2 is going to be the new reality in a lot of countries. We'll also touch upon capacity building concerns associated with Pillar 2. And finally, Akim will give a presentation and he will talk to us about the future direction of Pillar 2 or what we can expect.
I am fairly famous in the European conferences to not be a long speaker, so I will try to recuperate some time we lost in the start. First of all, I wish to express thanks to the organizers for being invited here. This is a very topical, obviously, and very important conference. And I'm very excited and happy to be here and get to know the FIT community better. So I will try to talk to more of you during the breaks. With that being said, while Pillar 2 sets the bottom floor for corporate tax rates, albeit with some restrictions, as Rachel guided us through initially, there are still opportunities for tax competition. And tax incentives are most definitely one of the avenues discussed for such tax competition, hence the sensitivity.
What could be the implications in case of, say, an investment structure where Pillar 2 provisions are complied with in the sense that there is no negative implication from Pillar 2? Could a taxpayer take a view that that itself should shut out GAR or CFC rules or the principal purpose test or PPT clause in a tax treaty? Or is it that the Pillar 2 rules are just one more set of anti-avoidance or anti-profit shifting tools in the toolbox of the tax authorities?
1 minute perhaps, just briefly, thanks for the question. I think, one, it is true, the basic policy proposition of Pillar 2 was to take the existing environment and then only create a top-up tax where there is a top-up tax to be created because there isn't sufficient tax levied yet, right? So for instance, CFC taxes are credited, withholding taxes are part of cover taxes. So you take the landscape as it is, and the policy driver really was that people felt that while we had done BEPS 1, essentially a lot of the underlying drivers of the profit shifting was still unaddressed, which is a very substantial discrepancies in effective tax rate, right? That's the underlying driver. So then we created a systemic solution in the Pillar 2. There is a discussion now in a number of countries, and you see this, whether in the wake of the introduction of a systemic solution to profit shifting, there's other things that can now be removed.
A very good afternoon to all. And before I start my presentation, I'll just make the disclaimer that I speak here in my personal capacity. So my views don't represent that of the government, and they are only my personal views. So to begin with, I have a slightly different view than what Vikram had presented.
Thank you.
So before going into the compatibility of globe rules with tax treaties, I'll just like to draw something from what the first introductory presentation that Rachel had made. That was about how the globe rules operate. So you can frame it in a different way. So there's a tax treaty world and there's the globe. There's the globe realm, or you can call the paradigm, or you can frame it anyway, but they're two different worlds altogether.
Mr. Rajat Bansal, he is currently the Principal Chief Commissioner of International Tax based in Delhi, heading all the international tax, transfer pricing, APAs and DRPs. He's also worked in CBDT in various capacities, including as the Joint Secretary, FTTR, and was a competent authority for various treaty negotiations. I mean, he has to be accredited with the amendments to tax treaties with Mauritius, Singapore, and he's handled several MAP and BAPA cases with Japan, Australia, China, South Korea for over 6 years.
Throughout the years, and the importance of intangible assets has increased. Business models of companies nowadays highly depend on intangible assets, and it only shows from the rise of IPs and, for example, the number of filings of patents and trademarks. Digitalization and globalization are changing, and the relevance of presence as a nexus for the levying of tax, given that the lack of physical presence would normally prevent the levying of corporate income tax. Meanwhile, the global tax community embarked on BEPS 1.0, and then continued with BEPS 2.0, and consisting of 2 pillars.
I mean, there's a lot of corporate hygiene in this area that can be followed as well, right? I mean, you know, one is like, how do you treat expenses? How do you treat your expenses? You know, are they just deductible expenses, or are you capitalizing them? You know, if you're capitalizing them, you're creating an asset, right? And if you're deducting them, then it could be just an operating expense for being in the business. Now, every distributor of a product will have to, one way or another, market the product, because, you know, chances are your consumer is not going to walk into your office without you showing that your product is superior or competitive. So you know, this is where we're grappling with, you know, how do you treat those expenses? What proportion of your operating expenses can be A&P, and how can you justify that? But also as to royalty rates, maybe one question is, you know, obviously everybody wants to have one royalty rate for the whole world, you know, because it's the same technology or IP that's being used. But maybe you really have to work on substantiating that for each market, whether that royalty is sustainable.
Thank you very much. Thanks, Eric, for the introduction and setting the tone of this session. Thanks to FIT and Mukesh ji for convening this conference after a gap of 4 years. And I have been here many times, and this is a very important conference, probably the best conference in India on international tax and transfer pricing. So the topic for today, practical considerations for Indian businesses. So we are, it has been identified that focus is on intangibles. So let me, before giving you the position of, or generally followed in the Indian tax administration on the transfer pricing relating to intangibles, I'll give you kind of a background. So transfer pricing of intangibles has been a difficult area of work for tax administrations across the world, as we all know. Situation has been the same for Indian tax administration.
So I think Rajat sir explained very, very beautifully, and there's no denying that the AMP issue is certainly the elephant in the room for most inbound multinational companies that are either purely just distributing in India or manufacturing and distributing. And assuming it's an international transaction, I think the real challenge lies where corporates are unable to take a path forward because there is no consistency or harmony in the approaches taken by the courts or the approaches that Sir just described on how the APS could get resolved. And therefore, should they be valued on basis of value, which the Indian business will get at the time of alienation of that asset globally by the parent, alienation of the legal ownership. And that's when, as part of the purchase price allocation, the Indian entity will also get compensated. And that alienation may never happen, which means the Indian entity may never get compensated.
Good morning, everyone. So when it comes to intangibles, I think we still rely a lot on Action 8, 9, 10. I think that is, if I may say, the Bible for how to look at intangible transfer pricing. And there are derivatives of that in our court cases and how it has been used. And if I may look at it in two baskets, if I look at the marketing intangible part of it and the hard to value intangibles as two different buckets. The marketing intangible answer, we've kind of, if I may say, settled down in the India system to a great extent, looking at the Sony Ericsson case.
Thank you, Rachel, for your very quick introduction. Welcome, everyone. Good morning. It's a great pleasure being here. And as Rachel said, the topic of my presentation is the current tax treaty issues, global developments. Well, so there are many issues related to interpretation and application of tax treaties. I chose three fundamental issues in interpretation and application of tax treaties, which are entitlement to treaty benefits, certainty in tax treaty application, and expansion of the taxing rights of source states. So when talking about the entitlement to treaty benefits, which is really one of the key concept or key issue regarding the application of tax treaties, I will focus on the principal purpose test, PPT, and the beneficial ownership.
Thank you, Ola, for your clearing. In the meanwhile, I have the pleasure to host Michael Leonard in our panel. So our panel enriched at the very last moment.
Unexpected pleasure.
Welcome. You are welcome. and please feel free to intervene whenever you feel it's the case. Ola, you guided us through the steepy path of some of the most controversial and difficult to interpret clauses encompassed in tax treaties. And we indeed need to consider, as Rachel said at the very beginning, the fact that as a substantial part of the economic actors.
What I thought would be useful is just to give you a little update on development in the UN and the recent meeting of the UN Tax Committee on some of the services issues. Of course, it's well known that inclusion of software and the definition of royalties will be the new model. Razmi is actually the expert on that. Another thing that's happening is that there's a proposal in the subcommittee before the committee to delete the deemed PE for collection of insurance premiums or insuring risks in your state, and instead to have a gross taxation of the premiums under Article 7. So that's still to be decided, but that's the proposal of the subcommittee before the committee, and the subcommittee is actually most of the committee.
Thank you so much, Walter, and good afternoon to everyone. So very quickly, to give you an overview of treaty abuse cases over this last 12 months. Most of you are aware that majority of the foreign direct investment into India has come in via jurisdictions such as Mauritius and Singapore. And therefore not really surprising that the more than a dozen tax rulings which we have on anti-abuse are vis-a-vis entities which are set up in Mauritius and Singapore. Very interestingly, though the revenue authorities, with respect to applying tax treaty benefits for sale of Indian securities resulting in capital gains, in spite of the article not really having a provision with respect to beneficial ownership, did really try to strike down the treaty benefits to essentially say that the structure lacked substance, they were not really the beneficial owners of the income, etc. However, the judiciary, of course, has provided the treaty benefits so long as the tax treaty, the TRC, is essentially in place.
Everyone, good afternoon. Just in the interest of time, I'm curtailing the presentation. I'd actually started with why treaty abuse and the traditional sources of limitation on benefits. But I think one very important concept for everyone to remember is that whenever treaty abuse is being looked at, it's very important to understand what are the different perspectives that an officer could have and under what provision of the treaty is he really going after you. And so in that context, beneficial ownership, limitation on benefits, and PPT, though interrelated, are different concepts. It's important to understand that beneficial ownership is really, it's an intensity of your ownership attributes on income.
So I thought let's perhaps look at some of the issues that arise from the three cases that I've mentioned over here, and look at it with a microscope, because the devil always lies in the detail. These three cases have raised several issues and have actually there are certain observations made which are often used as precedents. But I wonder if they really are precedents or if they are obiter dicta. So I'll take a closer look into that and perhaps raise more questions than answer them in the course of this presentation. So paragraph 100 of engineering analysis, by the way, I think most of these decisions, they come to the correct conclusion.
Good afternoon, everyone. Extremely delighted and honored to be here at this at this conference, and really it was really nostalgic to see Roy yesterday and all the professional luminaries here. So without much ado, please join me in welcoming. We have a very elite panel today to discuss a very apt topic, which is emerging technologies. While we are talking about challenges and prospects for the tax advisor, but we are also getting into a little bit of debate on what the tax advisor is really looking for. We're doing a little bit of crystal ball gazing into the future. We are going to be talking about the technology at present, the future of technology, the different concepts of metaverse, crypto assets, and of course, AI. No conversation can be complete without AI, and the role of governments, tax advisors, taxpayers with these, evolving technologies.
So I wanted to share, a little bit of, let me see if I can, there we go. So a little bit of the timeline of human technology, right? And in looking this up myself, I was actually shocked at some of the information that I learned. So in terms of sort of human technology, or it really begins about 3.4 million years ago with the first use of stone tools. And then from there, and granted, the archaeological record may be spotty in some places, but from there, it then took humans another 2.4 million years to control fire and use it for cooking. And then if we then fast forward, so you can sort of see in this timeline of sort of when humans sort of first appeared on this planet, 3 million years ago, and then, essentially all of the development, the main sort of technological development that's now happened really in the last couple hundred years, it's really quite remarkable.
I think that understanding the tax implication of crypto assets is fundamental also for tax advisors nowadays. To this scope, I believe that the first necessary step is to identify the taxable events of crypto assets. What are basically the taxable events that may emerge when we perform transactions on crypto exchanges, or simply when we keep our tokens in our portfolio? Well, tax literature, tax scholars across the globe have proposed a categorization which is based on the broad life cycle stages of a crypto asset token.
Certain objective criteria that central banks use in order to determine whether something is currency or not. And these two criteria are, does it meet the economic criteria and does it meet the legal criteria? So your economic criteria is sort of, is it a medium of exchange? Is it universally accepted? Does it have its own independent unit of account? And so many central banks seem to conclude that it doesn't really meet those standards. And on top of that, from a legalistic perspective, it's not considered legal tender. So you need to meet those two objective criteria in order for it to be viewed as currency. So that's one of the arguments as to why they discount cryptocurrencies as a whole from being a currency as we know it, as a fiat currency.
So I think that in India, we've kind of nuanced debate that we're having here, and it's also subject matter of the US case, in the Jarrett case. We've not had that kind of debate in India, and the broad understanding is that maybe you see mining as a service that the miner is performing for the community, which is your blockchain community, and the reward is a compensation for that service. So I think the view that's being taken in India is that again, the crypto that you receive upon mining or upon proof of stake, where you carry out the validation activity, that would be taxed on receipt as your business income.
I think it's important to take a step back, and I know this has been discussed quite a lot, in various panels, but let's just step back and see what really resulted in, this, formation of the committee. So if you look at the, resolution, this is essentially a culmination of, the United Nations Secretary General's report on how do you ensure more inclusive and more effective international tax cooperation? So therein, there were certain important observations which were made. One was that it was felt that, the two-pillar solution is essentially not something which the developing countries are really, very happy with.
Well, thank you, ladies and gentlemen. And it's been a pleasure comparing this show for the past 2 days, this conference. I've had a really fun time today, meeting a lot of people, and I hope to see you again sometime. So stay safe, stay well, good night, have a great journey back home.
Jackie, my sincere apologies. I didn't forget to thank you. I'm sorry about that. Thank you, Jackie.
Thank you.